back. It's time to cover the most important real estate news of December 2022. This month, we're covering the most recent Fed news, interest rate changes, projections into 2023, new county loan limits, and changes to credit score calculations. To lead off, we're going to check in with the Federal Reserve to cover some pretty significant news. The Fed met again earlier this month, and once again, they chose to raise the rate at which it lends money to major banks. The rate hike results in the Fed's highest rate in 14 years at 4.5%. This is the 7th rate hike this year and will make it even costlier for consumers and businesses to borrow for homes, autos, and other purchases. If, on the other hand, you have money to save, you're likely to earn a bit more interest on it. December's rate hike is part of the Fed's ongoing drive to curb high inflation, and the 0.5% increase is smaller than its previous 4 straight increases of 0.75%. The downshift reflects, in part, the easing of inflation and the cooling of the economy. The Fed's goal with all of this is to slow consumer spending, thereby reducing demand for homes, cars, and other goods and services that are typically bought with loans. This should eventually cool the economy and lower prices. Fed Chair Jerome Powell has acknowledged that aggressively raising interest rates would probably bring some pain for households, but that doing so is still necessary to crush high inflation. Last week, Freddie Mac reported that the average rate on the benchmark 30-year mortgage dipped to 6.33%. That means that even though rates have gone down over the last month, it's still about twice as high as it was a year ago. These high interest rates are keeping people from buying homes. In fact, sales of existing homes have declined for 9 straight months as rates have become too high of a hurdle for many Americans who are already paying more for food, gas, and other necessities. Does that mean that it might be easier to find a house at a good price if you're still willing to buy right now? Almost definitely. If you're financially able to proceed with a home purchase, you're likely to have far more options now than at any time in the past year or two. And right now, sellers are much more willing to pitch in with concessions to help cover costs. How much longer will this last? Maybe not much longer. In fact, several measures of inflation slowed or outright declined in November. Part of the reason why we haven't seen the Fed's rate hikes have much of an effect until this point is that it does take about 6 to 9 months for them to work their way through the economy. For this reason, some economists are concerned that the Fed may be overreacting. The next round of potential rate hikes will be announced at the first Federal Reserve meeting of 2023 in early February. The current expectation is to see probably another hike, but for it to be smaller than the past hikes, most likely at 0.25 percentage points. Now, there's still significant economic data to come in ahead of that Fed decision, and this could change the Fed's view. Now, most reports we've seen believe that the Fed is now close to the maximum level it wants to see interest rates, and the debate surrounds exactly where peak interest rates are and how long rates will remain at that level. On our level, we've seen this favorable news to begin lower interest rates. Freddie Mac publishes these monthly statistics, and in December, they're showing that mortgage rates continued to fall, posting the largest 4-week decline in 14 years. Freddie Mac's rate average comes from nationwide surveys of rates from various lenders, specifically based upon conventional, conforming, fully amortizing home purchase loans for borrowers who put down 20% and have excellent credit. The 30-year fixed-rate mortgage averaged 6.33% in mid-December, down from 6.49% from the first week of the month. Comparatively, we saw this at 3.1% at this point last year. The 15-year fixed-rate mortgage averaged 5.67%, down from 5.76%, but again, at this point last year, it averaged 2.38. Next, correspondent Alex Hess will fill us in on some important changes coming in 2023 to national mortgage guidelines. Alex, it's all yours.
With the news that inflation is finally being curbed, we're going to talk about another one of the major ways it's affected the home loan market, conforming conventional loan limit. For those unfamiliar, these are the maximum loan amounts that Fannie Mae and Freddie Mac, the 2 largest mortgage-backing entities in the United States, allow to be insured and purchased. With the exception of a few high-cost counties in places like Southern California and Hawaii, this loan limit is the same across the United States. They've raised it from 2022's limit of $647,200 to $726,200 for 2023. Just 30 years ago, it was only $203,000. Up until 2019, the value had even stayed at $417,000 for over 13 years, which mirrored the relative calmness of the real estate market. Since then, this number has been changed every year to reflect the median cost of a home in the continental United States. Now, as we've seen over the past 3 years, the median home prices have moved relatively by monumentous leaps and bounds. Most lenders will also recommend staying within these loan limits that we're mentioning because they have lower interest rates and they're easier to get approved for compared to jumbo loan products, which can be much more stringent and have higher interest rates. Now, this may mean putting down more from time to time or negotiating a new purchase price with your agent. With the increasing loan limits happening now, it gives more buyers the opportunity to have a more affordable mortgage product and get them out there shopping so they can purchase their own home. Good luck out there, shoppers, and see you next time in the Consumer Corner. Back to you, Chris.
Thanks so much, Alex. That's certainly some good news for those planning on buying in that range in the coming year. Lastly, we want to cover some changes coming to how credit scores are actually calculated by the credit bureaus. In my opinion, this is mixed news that may help some scores and it may hurt others. So what are the changes that Equifax, TransUnion, and Experian are implementing? Here are the 4 big changes you need to know. The first major change is my favorite. In the first half of 2023, the credit bureaus will begin removing all medical collection debt under $500 from credit reports. And then starting on July 1st, all paid medical collections will no longer appear on consumer reports. The credit bureaus say that these changes will remove roughly 70% of medical collection debt from consumer credit reports. I'm sure this is majorly positive news for the tens of millions of Americans who have together an estimated $88 billion in medical debt. The second change could have less exciting results. Buy now, pay later accounts will be added to credit files next year. If you've shopped online at places like Amazon, Walmart, Target, you've probably been offered the opportunity to pay for your purchase in installments through a model called Buy Now, Pay Later, or BNPL. With BNPL, customers pay for purchases over several weeks or months, often with no interest at all. Nearly 100 million US adults have used Buy Now, Pay Later plans to finance purchases over the last 12 months, according to a February TransUnion survey. But Buy Now, Pay Later accounts may be classified on your report as a short-term installment, and that could lower your score by bringing down the average age of your accounts. Third, consumers can access 3 credit reports available through the end of 2022. Early in the pandemic, the credit reports did something that was actually beneficial to consumers, allowing them to access free credit reports as often as once per week, as opposed to the normal once per year free report. That offer was supposed to expire April 20th, but the credit bureaus extended it until the end of the year. Through December 31st, you can continue to request free weekly reports online at annualcreditreport.com. Lastly, there's a new emphasis on what's called trended data. FICO 10, the newest update, will allow for rental history as well as trended data. This means that we'll consider factors like balances and payment amounts over a longer period, 24 months or more, as opposed to looking at a one-time snapshot of your debt levels whenever your credit score is pulled like it does now. That's all for this month. What did we miss? What did we get wrong? What would you like us to spend more time on? Let us know. I hope that you found this helpful, and if so, I would be incredibly grateful for a like and a share. Happy holidays, friends. I'll catch you in the new year.